Welcome to Pete's Property Podcast, brought to you by Buyers and hosted by Pete Wargent, buyer's agent, finance and real estate expert, and all-round property guru, plus published author. Join Pete for 30 minutes as he chats all things property with a new guest each week. Learn practical tips from the movers and shakers in the property industry and well-known personalities sharing their property journeys.
G'day, welcome to this week's episode of the Pete Wargent Property Pod. I'm delighted to have an old friend on the show this week, Mr. Stuart Wemyss from down in sunny Melbourne. Today we're going to talk about how to build a great investment portfolio. So Stuart is very well known in property circles with a planning background and also property advisory and a successful investor and business owner in his own right. But I'll let him tell you a bit about that as we go through. So Stuart, welcome. And firstly, tell us a little bit about your background. Where did you grow up? What did your parents do? That kind of thing.
So it's probably not my favourite topic, which is talking about myself, but I grew up in Geelong, which is an hour out of Melbourne, south of Melbourne. Did all my schooling there and university and so forth, and then moved to Melbourne to start as an accountant, a very boring accountant in audit, as most accountants start with. My parents weren't investors. In fact, I remember them contemplating buying an apartment off the plan in St Kilda Road, and this would have been early 90s, I think. Never went through with it. Anyway, and I made my way through the sort of accounting industry, through different jobs and opportunities, I guess, and spent a bit of time at KPMG, and then the most recent experience was some 20 years ago now at Deloitte. And I remember really as an accountant thinking about property quite deeply, and I could never really work it out. And I was sort of in my early to mid-20s at this stage. And I remember quite distinctly going for a walk, just around the suburbs and looking at property and just thinking, well, hang on, if I buy this and I lose money, so that is the rental income's not enough to pay for all the interest and expenses and so forth, how am I ever going to make money? Why do people invest in property? I couldn't put the two together. And of course, there was no internet back then. Gee, it makes me sound old. Mm-hmm. So there wasn't a lot of availability. I mean, you'd had to find probably a successful property investor, but I didn't even have the nous to do that at that stage. And I always had a strong affiliation for independent financial advice, which again through the 90s and even early 2000s, it just wasn't a very common situation. And I thought all you needed to do is have like an asset consultant, which big institutions have, but at a retail level. So you could go to someone that had no vested interests and they could tell you, look, put this much into property, this much into shares, this much into super. And it, to my mind, which is really independent financial advice, but that was really what I was thinking. And I would read stories and hear from people, that go off to financial advisors, which were entirely commission remunerated at that point. And they were just sold products and got really poor advice and terrible outcomes. And that used to upset and annoy and frustrate me a lot. And it wasn't until 2002 that I thought, well, hang on, I might want to have a go at running my own business. And that was really the impetus or the decision to leave Deloitte and start Pro Solution, my business, was mainly because I wanted to have the challenge of running my own show. But it really morphed, and we started doing mortgage broking because that was a really up-and-coming industry. In fact, at that point in 2002, you had to explain to someone what a mortgage broker did. That no one had it's very common knowledge now, of course.
Yeah, so that industry has really taken off because I think in the early 1990s, I think it was only around 5% of loans ever went through brokers. These days, about 2/3 do. And I think, people really see the value add in the industry these days, largely thanks to some of the big aggregating groups like Aussie Home Loans and AFG and Mortgage Choice and others. Before we just come on to talk about your career a little bit, my kids are dying for me to ask you. Are you related to Stig Wemyss, who I think, because you're from Geelong, big football city, of course, and I think he was the voice of the G of the football many years back, but these days he's the most popular narrator of kids' audio books in Australia, and it's a pretty unusual surname. So they've been asking, can I ask you, are you actually related in any way or no?
There's no relation. In fact, I don't think anyone with the surname of Wymes in our family has really done much with it. So, which I guess is a broad insult to all my relatives. But no relation there.
Yeah, it's interesting because it even looks a little bit like you. So on your career point there, so something that we do have in common, because I'm also a chartered accountant, and for my sins did a fair amount of time at Deloitte myself. It's interesting. I've met in the past couple of years people like, say, Peter Simpson Morgan, who is a legendary fund manager at Perpetual. So a lot of people would be surprised to hear he was originally a chartered accountant with a Big Four background. Also, the one drinks event, I was chatting to Ross Gittins, who's been Australia's premier business and economics journalist for the past who knows how many decades. And he too was actually originally a chartered accountant, and by his own admission, not that great at it, and then later moved into what he does today as the top journo. So often when young people talk to me about being a CA as a career, I always encourage them, if they don't have another plan, it's a great way to go, because it can lead you to work as an executive in any industry, but also it's a wonderful way to understand business if you want to go and do your own thing later on.
Yeah, exactly right, Pete. And really at the time in 2001 where I was sort of contemplating my next career move, because I wanted to work overseas, and I was going to go overseas with Deloitte to New York, to the New York office. And then, of course, September 11 happened in 2001. And so that didn't eventuate. And so at the time I was really thinking, well, do I stay in chartered accounting? Do I go into investment banking or something along those lines, which would have required me to do some more study in an MBA? Or do I go and pursue something on my own? But the point is, I guess, after a few years in chartered accounting, it gives you that background where you could, consider moving your career in lots of different directions. And I think understanding numbers, understanding business and financials, I think gives you that robustness almost in any sort of career progression, in investment, of course, and property, is very worthwhile.
Yeah, absolutely. And we're going to cover the subject today of how people can go about building a great investment portfolio, not necessarily in terms of scale, but just one that's really effective. Because I know that unlike many advisors out there, you do have a broad understanding of the property market, stock markets, how people can structure things to have a balanced portfolio to achieve their goals and the right end game. Before we come on to that, tell us a bit about your own property journey, because people always like to hear this part of people's story. So tell us about what have been your best, also your worst property decisions.
Okay, so my best one, I think, is that we bought a property down the coast for just shy of $2 million about 6 years ago. And at the time, it was a lifestyle decision to use it for personal use. It wasn't an investment decision. And at the time, I said to my wife, yeah, we'll do that. But look, it's a lifestyle asset. Those markets don't have the same robustness of demand that inner city locations do. So look, if we can just buy it and break even, from a lifestyle perspective, I'm comfortable with it. But I'm not sitting here ascribing a lot of capital growth prospects to it. Although I left room for the possibility, of course, it could happen, but eyes wide open. I didn't fool myself into thinking it was an investment. Over that 6 years, the compounding capital growth rate's been about 15%, thanks mostly to COVID. We did buy well, and we did buy at the right time and so forth, which is really just an opportunity that occurred. Is actually a bit of a story. We had a look at the property. We thought the vendors were asking too much, not only for that property, but for us at the time. We walked away. And then 3 months later, I received a random phone call on a Friday. We were actually out to lunch, and they said, the vendors have lost patience. They're selling. Give us your best and final. And of course, when an agent says that to you, you think, am I being played here? Is that what's happening? Anyway, we worked out, well, here we were prepared to pay 1.9. We put in an offer for 1.87 or something like that, just a little bit shy of the maximum we were prepared to pay. And we bought it on that day. So it shows you can sometimes you can overthink property and negotiating and shoot yourself in the foot, but also you've got to be prepared to react when a deal comes along. And, as I look back, that has been an extraordinary amount of growth. As I said, not through necessarily my design, but mostly thanks to COVID, that property decision has worked out tremendously well for us.
Yeah, fantastic. And of course, some personal use, some beautiful coastline in Australia, which has really come into its own over the past couple of years. Let's talk a bit about if somebody comes to you planning to build an investment portfolio for the future, got a decent salary and so on, but where should they even start? And do you encourage people to do some kind of goal setting exercise first, or is it a fact finder that you send out? How do you go about making a start with clients?
I'm going to talk about that, but before we do that, I wanted to also share my worst property decision because
yes, and these are always more popular than the best decisions. Strangely, people love to hear about the bad choices as well.
If everything goes well, it doesn't really give us a lot of opportunity for learning. But I wanted to share it because I think it demonstrates that everyone through their cycle of educating themselves makes mistakes along the way, of course. So in 2004, about 2 years after I started my business, I bought a property off the plan. And I have since that experience been writing why properties that are sold off the plan and just make universally terrible investments. Maybe good for own-occupier if that's what you want, but from an investment perspective, no good, which is maybe a topic for another day. But anyway, I bought it in 2004, settled 2005, paid $390,000. It was a boutique development. It was in a really good location, albeit on a main road, not a massively busy main road, but a main road nonetheless. And I realized about 3 or 4 years later that this is a mistake, that it's stupid, I should sell it. And I sold it in 2009 for $450. So it wasn't a terrible mistake, made $60,000, which isn't going to change anyone's life, of course, but I exited the investment. Because my memory's terrible, when preparing for this podcast, I went and had a look at those figures to remind myself what I paid and what I sold for. I saw that it sold last year for $525,000. So looking back in 2009 to make the decision to exit that investment, clearly in hindsight now, particularly if you think about the growth that's transpired since 2009 over the last decade, it was a good decision to sell because there really hasn't been a major uplift in value. But it shows, I think, firstly, probably the biggest lesson there is if you've made a mistake, correct it and move on. And sometimes the correction of a mistake can be painful. So particularly if you're selling a property at a loss, but there's never really a good justification to hold on to a poor quality property, just like there's never a justification to buy a poor quality property. So I wanted to share that worst property decision because I think it's important to show people that reviewing performance of existing assets, which I'm sure we'll talk about, and then also making friends with or coming to terms with past decisions may not have been always correct, and making changes and moving on is always important.
Oh, yeah. Look, I mean, I haven't been in the advisory space anywhere near as long as you, but I don't think I've ever had somebody come to me and say, oh, look, everything went perfectly. There were no glitches along the way. That's just not the way the real world works. As you said, you can only really take the lessons from the suboptimal outcomes and enjoy the good stuff and just try to sort of look forward, because looking back with regret doesn't really serve any purposes. You can only learn the lessons and move on. So yes, so coming back on where to start. So where do you start out when somebody's, if somebody was trying to avoid making howlers and mistakes and they wanted to build a great portfolio, where would you commence with that?
There's a bit of tension really between setting long-term goals and setting short-term goals, particularly for investors that are young and that are starting out. I would say, as a general rule, setting long-term goals is very wise because it helps you focus on long-term outcomes. And by focusing on long-term outcomes, it helps you really focus on the fundamentals of investing rather than what is popular or what's the main risk or the main popularity currently in the market. And if you listen to all the noise, that's really what you're going to learn is what's the theme that's going on in the media today. But mostly those themes aren't very useful in informing investment decisions. But then the counter argument to that is when you're young, so much can change so quickly, not only in terms of your circumstances, but also in terms of your wants and desires and your goals and so forth. So I don't think necessarily it would make sense for every person that's in their mid-20s to sit down and draft a 30-year financial plan because so much is uncertain. So I think that the best thing that I try and educate people to do is balance out short-term decision-making with long-term decision-making and really try and lean in towards the long-term decision-making as much as you can. The irony with human behavior, Pete, which I'm sure you've recognized, is the older we get, the more used to we get making long-term decisions. Whereas when we're younger, we tend to be more impatient. And of course, our smaller asset base, I guess, feeds that impatience as well. I've got a low asset base. I really want to improve it over the next couple of years. Whereas once you've got a substantial asset base, you don't have that anxiety around that or that urgency. But really, it should be flipped around to some degree that younger people would be best served by really focusing on making good long-term decisions. I guess meme stocks and Bitcoin and all the sort of stuff that's been very popular over the last couple of years is a perfect example of that. Some people have made some really good money in some of these things because it's all about timing. But in terms of making good long-term investments, so where I typically start, where if it's appropriate, is try and counsel my clients to buy a owner-occupier property first, but apply an investment lens to that decision-making. So buy an investment-grade property and occupy it and buy to your maximum budget, the maximum you're most comfortable with, of course, but really try and push yourself for that first property acquisition. Buy it with investment fundamentals and then occupy it. If your circumstances allow that, that would typically be the best first.
Do you want to save on buyer's agent fees? You could save thousands with Buyers Buyers. As Australia's most extensive network of buyer's agents, we can lock in highly competitive prices. Plus, our national network of buyer's agents are some of the best in the business. So get the Buyers Buyers advantage and talk to us today. Call 1-800-975-051 or visit buyersbuyers.com.au.
Interesting you mentioned there the tension about how much life can change over 10 or 20 years, and it certainly can. But from an investment standpoint, taking that long-term view is so useful. I'm reminded of there was a Warren Buffett interview where he was being asked why he didn't use more leverage in the investments of Berkshire Hathaway. And he basically said, well, look, Charlie and I knew that we would be wealthy over time. So they didn't need to take silly risks because they just understood the mathematics. And I think, as you said, when you're younger, to a certain degree, you've got less to lose. So therefore, taking some big risks on more volatile investments can be quite appealing. But it is also the time when you've got the longest runway, and just 2 or 3 really good decisions at that point could make such a big difference to your future. So you mentioned there the impact of borrowing capacity, because that's one of the things that's really changed over the past 10 years and 20 years is the lending landscape. So do people need to have a different understanding of the lending environment, and do they have to have some kind of a borrowing plan if they're going to do property?
Oh, absolutely. So that's the number one scarce asset, really, is borrowing capacity. So people think, investment or investment opportunities or really good quality properties, that's the scarce asset they're worried about. or even to some degree savings. The amount of savings they've got, that's the scarce asset. Not really. For most people, particularly those starting out, borrowing capacity is your scarce asset. And so there's two things you need to do with the scarce asset is proactively maximize it as much as you can. So get as much of it as is reasonable and appropriate. And then secondly, allocate it wisely, allocate it as efficiently as possible. So, I mean, it's a common thing, for example, where people go, oh, look, I've got this property, isn't really performing, but it's paying for itself, the rental income pays for itself, and so I'll just leave it there. That's great, but it's eating up a scarce asset, which is borrowing capacity, and you could be doing something else with that. So, maximizing that. And when I talk about maximizing borrowing capacity, I'm not talking about borrowing to your eyeballs or being so stupid or not even thinking about, the impact of future interest rate increases, but really maximizing borrowing capacity in a way that still mitigates risks in the future. And so sometimes, for example, borrowing more and leaving yourself more of a cash flow buffer and offset and so forth is actually less risky than borrowing less and exhausting all your cash. So sometimes when you say, oh, look, borrow as much as you can, it comes across sometimes as very sort of aggressive, but it's not really that. It's really about making sure that you're putting your equity to as best use as possible. And not always, but mostly, a higher budget will allow you to buy a better quality asset. And a better quality asset over the next 10, 20 years will deliver extraordinary returns.
Yeah, so this is probably the question that people have more than any other, and that's in terms of where and what to buy to maximize returns. Now, I often think about the principles of investing, and diversification being one of those principles that people look to adhere to. In fact, I think when you're self-managing your own superannuation, you have to say that you've considered diversification. But I think what you're talking about there, if you're buying a place of residence and potentially an investment property where you're saying buy the best quality asset that you can, obviously it's very difficult then to get much in the way of diversification. I guess you've potentially got your own home, an investment property, plus your superannuation. But would you always suggest to buy the most expensive property that you can with the borrowing capacity? Would there be any circumstances where you might say, well, maybe buy two in different locations to spread the risk, or no?
I mean, I acknowledge that having some geographical diversification is good, that holding several assets gives you more flexibility because you can sell one, keep one if you want to reduce debt. That having two assets probably has a marginal improvement in income, so yield and expenses and so forth. So acknowledge there's some benefits, but really quality is the most important thing. Without a doubt, quality is key. And I think, to my mind, if you remember that as a golden rule, if you're going to obsess about anything when it comes to investing, and that's investing in property or any other assets, if all you do is obsess about quality and you forget the rest or outsource the rest, you'll be incredibly successful over long periods of time. But quality trumps quantity or diversification every day of the week, to my mind. Now, that's not to say every single person should do that, put all their eggs in one basket, but I would say that more people than fewer would be well rewarded by putting all their eggs in one basket and really, really finding the best quality property. Now, I would argue that reduces your investment risk rather than increases. And the reason I say that is that if I'm buying a pink diamond, not just a normal white diamond, they're in shorter supply and always higher demand. And even if the economy changes and I've got myself a really good pink diamond, I'm always going to be able to sell that. And I'm always probably going to be able to sell it for more than I bought it for. Whereas, normal white diamonds, dime a dozen maybe, and a little bit more open to the vagaries of supply and demand. So I think by levering up in quality and putting all your eggs in one quality basket, I'd argue you are, to some extent, reducing your investment risk, whilst at the same time acknowledging there are benefits of diversification, which hopefully you can achieve over time. But for that first initial investment, it's definitely buy the best quality property you can afford.
Yes, for sure. Now, as you said there, if you're taking a long-term view and you potentially own maybe 2 or 3 investment properties over time. Obviously, that can do a great deal for people over the long run in terms of growing their wealth and their equity. But you mentioned at the start there how the rental yields in residential property in particular tend to be pretty low. Now, yeah, for sure, the rents are going to go up over time, and presumably at some point the debt gets reduced as well. But what do people do generally, and what do you say to your clients about the end game? Do you have people that aim to live on rental income, or do they sometimes sell down properties in the end game and invest their money elsewhere?
Look, I think, well, first thing, I think you got to have a plan on how it all fits together. Not only just your property, but, most people are forced to obviously contribute to super. So there'll be some super assets, but obviously that income stream doesn't kick in until you're 60 or older. But still something to consider about, how does that play out in your investment strategy? And if you want earlier retirement, that's fine, but super still will play a role. And then it's really then allocation of surplus cash flow and what that looks like. So if you've got a lot of surplus cash flow, you expect to, well, arguably you might be able to build some more liquid investments that derive more income, like a share portfolio, as well as potentially reducing some of the debt on the property portfolio. And if you've got a long enough runway, that could do its work. And then the combination of, net rental income and some dividends, and then eventually some super pensions will be enough to fund retirement. But if you don't have enough surplus cash flow or long enough runway, well, then you've got to look for other ways to reduce debt, which could be buying assets today to sell in 10 or 20 years' time to reduce debt and achieve it that way. But property is always going to be a pretty lazy asset income-wise, particularly percentage of value-wise. So I think it's really about choosing the right assets to do the right things in the portfolio. Much like in golfing, you don't tee off with a putter. You choose a driver because that's the club that's going to give you the most efficient outcome for what you want to do. So property's a growth asset, and that's fine. If we need income, we should really be looking to other asset classes.
Yeah, you may say that, but we live on the 18th hole at Noosa Springs. I've seen people after a few Coronas teeing off with putters, playing left-handed, doing all kinds of silly things. So, yes, but in the investment sense, I wouldn't recommend it.
I wasn't talking about Queenslanders, of course. So, I mean, I don't know if it's the beer or the Queenslander in them that was driving that, Pete. So, anyway.
I think, to be fair, it's usually Southerners on holiday. Now, a big topic at the time of recording is inflation has just started to rise in Australia. I mean, it's 2.6%, so it's not exactly running away, but and that's coming off 7 years of very low inflation. But a lot of the narrative is like, well, the economy is rebounding very quickly. There's huge amounts of fiscal stimulus in the economy. The Reserve Bank's going to stop with its QE program. And we might need to start thinking about higher interest rates, which for property obviously is very important because the impact on mortgage rates at which people borrow and the likely impact on housing market sentiment and so on. So my final sort of question or topic for today is, what do you think the outlook for Australian property and housing might be over the year ahead? But I suppose more importantly, in the context of what we've talked about, what do you think the outlook might be over, say, 10, 20 and 30 years? Do people need to worry about rising interest rates, or do they just need to look through and take a longer term view?
There's a gentleman by the name of Rob Arnott who runs a business called Research Affiliates in the US that formulate sort of investment strategies, if you like, and different types of indexes. And he put the question, mostly for share investors, of course, but it equally applies to property investors, to really sit down and ask ourselves, what will matter in 5 years' time? And it goes to, not because I'm taking a 5-year time horizon, but really I think it's a really good question to ask ourselves. So will COVID matter in 5 years' time? In his view, definitely not. Will interest rates or inflation matter in 5 years' time? Maybe, but maybe not to the extent we might be thinking today. Will demographics and population growth matter in 5 years' time? Absolutely. So I think when we ask ourselves those questions and force ourselves to think a little bit longer term, just outside of the the current news headlines, I think what it does is it really inform us and paint a really good picture on what prospects the property market could offer us over the next few decades. And to my mind, I think I'm very optimistic about property and property growth in Australia over the next 10 to 20 years, mostly because of population growth. The return of skilled migration will be absolutely necessary, of course, and might even solve some of the inflationary pressure. Of course, we've still got a problem around wage inflation, whether we can generate sustainable levels of that. And then I think then also when we look at the statistics, the raw numbers, when people sort of consider, do I want to go and live in the US, Canada or Australia? When you look at the raw numbers, forgetting about the draconian lockdowns in some states, like in Melbourne, for example, the raw numbers are going to look good. Australia's done a pretty good job, and people forget, that the vaccine wasn't ordered and all those sorts of things very quickly, and we just live with those numbers. So I think COVID will serve Australia well in terms of making a very popular destination for skilled migrants. And I think our economy relies on that sort of population growth. And I think the underlying economy is in incredibly good shape. And then, of course, we've got iron ore that we pull out of the ground, and we can talk about whether China is going to keep buying and all those sorts of things. But I don't really foresee too many changes in that space. So I think the underlying economy is really strong. I think population growth will be really strong. And for all those reasons, I think investment grade property in Australia will perform strongly compared to other asset classes over the next 10 to 20 years. What will it do this year? It could be a supply question. It probably depends on supply. So, there's some markets that are well undersupplied, like Brisbane. There's other markets that are kind of normally supplied, Melbourne more recently. So I think it depends on supply. But if supply it remains relatively tight, I think that'll underpin current property values, but it's not that important. The only thing important about supply is there a property that I'd like to buy today that ticks the boxes that I need to tick? In a tight supply market, quite often that's difficult to find. But when supply increases, it can become easier. That's the only thing I think about as an investor, whether supply impacts me. I'm really just thinking about what's going to happen over the next 10 to 20 years.
Yes, I think, we mentioned Uncle Warren earlier in the podcast, and he often talks about, instead of watching the share price day to day, maybe have some other metrics that you think about, in terms of, are the businesses or the investments that I've got, are the underlying fundamentals improving or not? So in the context of a property investment, I guess, as you mentioned, the long-term fundamentals are really population growth and the wealth of the nation. And if those things are moving up over time, yes, there'll be ups and downs for property. But if you're taking a 10 or 20-year view and the population's growing very rapidly, which the outlook for a big Australia suggests will be the case, and if people are getting wealthier over time, then generally that translates, certainly in the popular landlocked suburbs, to rising land values and housing prices. But there's, as you mentioned, an awful lot of media headlines between now and then. So
that's right.
Yeah. So just wrapping up on today, obviously you've got a couple of decades of experience in the advisory space. So if people want to get more of your content, and I think I must have said on a podcast somewhere else that I've subscribed to so many newsletters over the years, but there's only really 2 or 3 that I actually bother to read. And yours is one of them, because you put a good deal of thought into the content. So if people want to subscribe or learn more about what you do at Pro Solution, where should they go for more?
They could just Google Pro Solution or Investopoly, which is my the name of my podcast / blog, or my name, Stuart Wemyss, and they'll find my blog. And if they like to read things, they can certainly subscribe to that. If they like to listen, I record it in an audio version. So it's not a traditional podcast where you have an interview, but I just really record the audio version of my blog for that week. And that's how people can probably get to know a little bit about me and my approach and thought process and so forth.
Fantastic. And yes, hopefully catch you in one of the wine bars in Melbourne sometime soon. Haven't been allowed in for a couple of years, but hopefully they'll be kind to me soon and we can catch up in real life. So thank you so much for coming on this week, Stuart, and look forward to hearing more from you in due course.
Thanks, Pete. Been great.
Thanks for listening to Pete's Property Podcast, powered by Buyers. Don't forget to subscribe and join us next time as Pete chats all things property with a new guest. And just a reminder that the information provided in this podcast is general advice only and doesn't take into account your personal financial situation or needs. You should always consult a licensed professional to discuss your individual personal circumstances.